we're going to go into talking about the people out there who have received extra funds. Like typically, you might be making $40,000, but because of hazard pay or you're getting bonuses for working at your job during COVID, you're getting extra money. Now, you got extra taxes. So I wanted to come and talk to you guys about that because first and foremost, it's great to receive extra money, but then you got to pay taxes on it. So I've been getting nurses and teachers for one that have received extra pay for basically doing their job, but due to COVID they're getting extra money. And I've had some people where it's like $20,000-$30,000 more than what they typically get. So now they're trying to figure out like, okay, well, I didn't ask for this. I'll receive it, but I didn't ask for this, and now I got to pay taxes on it. I mean, that's how it works. But yeah. So what do we want to go into, and what we're going to be talking about today is receiving extra funds, not bonuses, but extra funds, hazard pay, extra income, a higher rate of income basically from your job, and now you have to pay taxes on it. So like I said, I've been getting nurses and teachers that have this. If you are somebody who's received hazard pay or extra funds because of COVID, and you don't typically get that, drop your profession, because I haven't received any more. So drop your profession in the chat box, so I can know, because I'm pretty sure there's other types of jobs that are doing this, but I haven't come into contact with them yet. So yeah, drop that below. Make sure you guys are liking and sharing this for me. I appreciate it. It needs to get out to a lot more people. So let's get started with this. All right. Hopefully you guys can hear me. Say hey when you get here. So basically, hazard pay was dropped into effect in multiple industries. The ones that I've seen is nursing and teachers, but it has been dropped into play where people are getting paid more to go to work just because of the situation. Fine and dandy. I like it. I'm glad they stepped up and, were able to do that for more people, because you are putting yourself at risk. But, so you're getting more money. But now, like I said, if you are making $30,000, or let's take it up higher. Maybe you were making $70,000 a year. Okay. And now with the hazard pay, you're making an extra, we're just going to round it off to an extra $30,000. You're at $100,000 for this year. For last year, or even this year, you're still getting hazard pay, and now you're just like, dude, I got to pay all these taxes and never have been in this tax bracket before, right? With some people, it threw them completely out of a tax bracket. I wanted to bring to you 5 different ways. Let me see, how many is there? There is 1, 2, 3, 4, 5 different ways that you can lower your taxable income. So let me get into that. So what is taxable income? So basically, all the money you receive. So if you work multiple jobs, all that income. If you have other sources of income, all that income. Unemployment is considered income. There is, what is it called? Oh my gosh, I had a brain fart. So wages, unemployment, retirement plan distribution. So if you have a retirement plan and you take out money out of that account, they call that, they basically tax that as taxable income. So you basically take all the forms of income you have, you put them together, and that's what you're going to be taxed on. Well, let me go back. That's, they're going to tax you for federal wages, the FICA, and all the other stuff. I can't think of the names right now because I'm having brain farts for real. But basically, you're going to be taxed on that. You usually get taxed on that when you do the distribution or you gain that income. So you're usually taxed on it there. They pull out the federal taxes too. But, all that income is going to be taxed, right? When you go through and you put all that together on your taxes, they're going to tell you, you fall within this bracket. This is how much you should have paid. Now, your federal, if you don't have enough in federal, I mean, you're basically paying your federal out of the money that you're receiving before you receive it. Then you go to your taxes and they tell you like, okay, you paid too much, you didn't pay enough, and then you either get a refund or you have to pay. So, one of the things that can offset how much your taxable income is what we're going to talk about right now. But the goal, more money, more problems. The goal is to lower, like receive the money, but lower how much you're being taxed. So let's just say you made $200,000 last year. You want to start doing stuff, putting things into play to lower your taxable income. So you're going to be taxed less as you drop that income. So what I'm going to talk to you guys about and give you guys some tips on are ways to do that on your tax return, things you can set up today in your life so that when it comes to tax season, you're like, hey, I made $200,000, but I'm only going to be taxed on $140,000, and your taxable brackets, they change. I don't know if it's 140, but it's somewhere in there. I'll get you the taxable brackets just to make sure. But, as you lower your income, you're taxed less, okay? I mean, even if you are making that high income, there are different things you can do as an employee, W-2 employee, to lower your taxable income. You don't have the Schedule C. You don't have that all the different tax breaks as the business owners. I get a lot of high income, high earning W-2 employees who we need to put something in place, because I personally don't feel right with you guys paying all those taxes. So yes, we're going to talk about that right now. So what can you do if you are making a lot of money as a W-2 employee and you do not have a business on the side? Like, I tell a lot of people, go start a business, and they're like, I don't even have no time for my own for me. But when you start making more, then there's other things you can do besides starting a business. So if you don't want to start a business, the first thing you can do is, if you have any medical expenses, you can use these medical expenses that you paid during the year to put onto your tax return. So I want to break down one more thing. Everybody is given a standard deduction, okay? So if you're single, if you're head of household, if you're married, filing jointly, if you're married, filing separately, you're giving a deduction automatically. So for married filing jointly, you get $25,000 off of the income already. So the stuff that we're going to talk about, it has to be over the amount of the standard deduction for it to make an impact, okay? So if we do all this stuff, and so let's say the standard deduction is up here at $25,000, and you only have $10,000 that you're going to put into play with the stuff we're going to talk about, then it's not going to work. What you need to do is raise it over the standard deduction. So maybe $30,000 instead of even $26,000. I mean, anything over the standard deduction is going to actually help you. So when we put this into play, we just need to make sure like we're bringing in everything and seeing if it actually helps. So the first one is medical expenses. Let's just say you have, children, they need braces. Like, you're making this amount a year, you're making $200,000 a year, and you already know that you're going to have to pay for braces. Do that this year that you're making all that money, to use it as a tax deduction, okay? So you can basically write off your medical expenses, or you could do, you have a medical procedure that you need to get done. You can actually use that on your taxes. So now that's chunking away at you getting up to over your standard deduction, okay? So another thing that you can look at doing is donating. So donations you can use, and you can basically say how much you donated, how much it costs, basically the basis of it, how much you're writing off. But you can put that on your taxes. So let's say you donated, $3,000 worth of stuff. You took some stuff to Goodwill, or you donated to an organization that you like, or you tithe. You can use all of that. You can use all of that for the whole year to put on your taxes. Now you're, again, chipping away at getting to over that standard deduction. So charity for sure. Then there's retirement accounts. Okay, so retirement accounts, you can do a 401k, you can do an IRA, and there are certain limits that you can actually put into these accounts. I think with the 401k, you can actually put in $19,500 that you can use on your taxes. With the IRA, it's up to $6,000. If you're a certain age, it goes a little bit higher. But you can use this stuff, and as you're chipping away at it, it starts to raise the amount that goes over the standard deduction. So 401ks. Oh, I want to talk about 401ks right quick. I'm kind of back and forth with the 401ks, just because they're tied to the market, and it makes a little bit of a difference. If the market goes down, you kind of lose your money, and I've seen a lot of horror stories. So, with the 401ks, it is iffy. You have to understand that. I know a lot of people that get 401ks when they go to their job, and they do that because the company typically matches them. So another thing you can do is have your own 401k. Okay, instead of having it at the company and they're matching you, you can actually have your own 401k. You don't have to worry about if you leave the job, is it going to follow you, or what do you got to do and moving stuff around. You can have a solo 401k of your own that you manage, you put money in. It's not being matched, but it can help you on your taxes. So that's something that we can definitely get set up for you if you were looking at that. Another one is the IRA. The IRA, it is pre-tax, but the money goes in pre-tax, but you can contribute up to the $6,000, and down the line you can convert it over to a Roth IRA. Okay, so that is two different things that you can do with retirement funds, retirement accounts, and then the fourth one is an HSA, a high deductible plan. It's called the HSA. It's connected to a high deductible plan. And with the HSA, I think you can contribute up to $6,000 also. But like I said, it's chipping away. And as you get higher and higher with all these different things that you set up, it's going to lower your taxable income. Now you're setting up these different plans for yourself, and you're taking care of stuff that you're already going to take care of. And you're not paying it to the IRS and still having to do this stuff on the backside. So, it's not like you're having both of the expenses. When you do this and you take care of your own household, you contribute into these plans of your own, you're basically able to write it off and pay less taxes. Okay. So another one isn't really like a plan you can set up. But it's a possibility that your company might be able to give you supplemental pay. So supplemental pay is basically you have your regular pay that's taxed with all the different, FUTA taxes and FICA and federal. And then you have supplemental pay. Supplemental pay is at 22%. And when you do that, it's kind of like separating them out. So you might want to ask them like, hey, all this extra pay is a possibility to set it up a different way. So I'm not taxed on the full, with all this other stuff. You're just being taxed as supplemental pay, that one-time payment, that one-time taxing, and you're good to go. So, those are a couple different things: pay medical expenses, supplemental pay, donate to charity, HSA accounts, retirement contributions. All of them make a difference. Now, there are, W-2 employees who do not want to get a second, get a, business on the side to lower, use the write-offs, blah, blah, blah. And this stuff can actually help you. So I hope you guys got something from this. If you ever need, let's go back. If you ever need any help with any situation where you're just like, I have no clue what's going on, hit me up, please. And if you've talked to anybody, I definitely can give you a whole bunch of information. A 15-minute call with me will do some damage. But my goal is to basically help you guys keep more money in your pocket, because not everybody knows. It's taken me a long time to actually learn all this stuff. I've been a tax preparer for 5 years. I've been licensed health and life and health agent for almost 5 years also. But all this stuff, it's a lot. We're not taught about this everywhere. So if you ever need help, hey, just come set an appointment, please. Because walk-ins are going to get me. I'm going to be on the phone with somebody. I'm going to have 3 walk-ins. Now we need to book an appointment. You can definitely find the website on my webpage. Or if you need to just send me a DM, I need to get on your books. Get on my calendar, because at the end of the day, I'm here to help you guys, bring you valuable information. These high income earners, I don't want to see you pay taxes. I want to help you not pay taxes. I do tax planning. You know, we have myself, and I have a rep that is able to help me do tax planning. So at the end of the day, when you're done paying the IRS all this money, or you get this $40,000 bill and you're like, listen, I don't want to have to pay this kind of money to the IRS. Hit me up. Let's talk about it. Let me go through my little unnecessary questions so we can get to the bottom of how I can help you. And then, you know, put a plan in action and to help you save some money. So, if you guys need any help, I am here. If you have any questions about what I just talked about, drop them below. Like, share, and comment on this video, so that, you know, other people can see it. Help me beat the algorithms. And I think that's all I have for you guys. And again, thank you for all the love today. It's been a beautiful day. I'm about to go have lunch with my family, and I am late. OMG. So I will talk to you guys soon, and have a beautiful day. Bye.